Morning, Mr. Smithers. How are you feeling today?
Good morning, Mr. Burns. Monday morning, not my best.
Good weekend?
Very good weekend, yes. A couple of light beers on Saturday night down the coast.
Oh,
Open
really?
fire.
Flashed out, I hear.
Oh, yeah.
Light beers. 2, 3?
Yeah, I'm feeling quite wealthy at the moment. Must be that...
Must be the wealth effect kicking in.
the cash flow channel, maybe, because, I'm not... doesn't cost me as much to service my debts.
Well, the house prices are going up in your area. We're going to look at your house later on. I've got a picture of it.
Righto. All right, well, let's get into it.
Monetary policy. Great topic, students. One of my favourites. Clearly, it's about manipulating interest rates to affect the level of economic activity. As you can see here, we've had a very loose monetary policy setting over the recent years. And we'll talk a little bit about that later on, but you really should know what's been happening to interest rates in the last 2 years and especially, and the last 4 years generally. And it's quite an easy one because they've been falling, as you can see.
Yep. And there's May. You should know the last cut. That was May. And the two cuts last year, which were May and a month earlier than May, I think.
I'm not quite sure, to be honest. But also, don't forget, this week, CPI data comes out on Wednesday. We'll talk a little about later on. But also, if it's low, could be another cut this year. And obviously factor that into any answers that you have in the end of your exam. Let's punch on.
Righto.
Bit to get through. What should you be able to do on this topic? Well, you need to be able to define the role of the Reserve Bank of Australia. You need to be able to talk about the instruments of monetary policy, not in huge amounts of detail, but you should know about open market operations, the impact of intervention in the foreign exchange market, and persuasion. Now, we're not covering these three things today because we'd be here forever if we did the full lecture on monetary policy, but they're three things you should know. Stance, loose and accommodative stance currently, but you also should know what is meant by a restrictive stance. Transmission mechanism, we'll run through that briefly today. And its goals. This is an area that we're assuming you've gone back and revised the goals, but we're not covering it. But there are 5 key goals, and it's quite likely you'll get a question both in your SAC and in the end of your exam asking to explain how monetary policy or change in interest rates, it might say a tightening or a loosening, impacts upon one or two or more of the goals. And that, by implication, means you know what the goals are. Strengths and weaknesses, of course, and policy mix, I think there's one more, I think there. You should also know about that. So we'll touch upon those today.
Excellent. Good work, Mr. Burns.
Oh.
On to our next slide. So remember that, and my class went through this again last week when we were talking about the goals of monetary policy and what is actually stated on the Reserve Bank website, Mr. Burns' favourite website.
It is indeed.
To maintain a stable currency in there, we are talking about inflation. So that is the goal of 2 to 3% over the course of the business cycle on CPI data.
Go on. No, I was going to say the overall, and then from that, stability of the currency, full employment, and work towards the economic prosperity of all Australians. And that allows them to have that inflationary operating target of 2 to 3% over the business cycle, but allows it to be over the business cycle. So they're not going to target inflation for the detriment of the other goals in the short term. And that's why there's 3 goals there.
Yeah, and they're always looking at the medium term and the long term. They look over any short term fluctuations usually, particularly on the cost side.
So here we've got the most recent stuff I can get off the Reserve Bank website. And whilst you need to know what the Reserve Bank's trying to do, really you need to know how interest rates impact upon economic activity. How do they change the spending and saving of consumers, businesses, households? What do they do and what are they trying to do? And we've got a bit of time to spend on that. But clearly here we're trying to see I've tried to provide a bit of a relationship here very coarse relationship between falling interest rates and rising growth.
So there's the growth on the left, and what we're trying to do obviously is stimulate aggregate demand with the lower cash rate through those transmission channels and increase growth. Mm-hmm. So getting growth up to at least that 3% more consistently. And they've had some success just recently, and monetary policy is a little bit to do with that. I think this graph on the right also we can talk about these lines up here, or these graphs up here, which talk about the retail.
Good point.
And this was mentioned, and I talked about this with my class, and I know Mr. Burns has. These are the retail rates. So these are what consumers are actually paying in the marketplace. They're not paying the 1.75 on their loans.
That'd be nice, wouldn't it?
That'd be lovely.
Yeah.
They're paying this retail, or I think it's fair to call it a commercial rate.
Correct.
So what you can do is talk about that in relation to how the transmission mechanisms work.
So, the gap between those two rates obviously is the margin the Reserve Bank's charge from the cash rate and the retail rate, or the rate that we pay as mortgage holders, that businesses pay when they're borrowing to start up a new business, that consumers will pay on a car loan, for example. Those sort of key interest rates out in the market.
All right.
So next, as we mentioned earlier, their operating objective is inflation. Now, the actual Reserve Bank website talks about targeting the CPI, the Consumer Price Index, but they also do look at the underlying rate of inflation. So that we haven't got that in here today, but that is something also you need to be able to explain the difference between the CPI and the underlying. So they do look through the CPI data and have a consideration of the underlying rate of inflation as well. The good speech Glenn Stevens made, you showed us earlier in the year, where he said one of the key reasons why they target inflation is because it takes away uncertainty in business decision making, and that's a really, really good point. He made it clear that if they can get inflation, the Reserve Bank can keep inflation under control. It's one less thing for businesses to worry about, and it has worked pretty effectively in Australia over the course of the last 10 years or so in terms of inflationary targeting.
Mind you that they're struggling to get businesses to invest at the moment, and even at these low rates. But most certainly, it is that certainty that they think is the stability from which you can build on achieving the other goals.
Mm. So the question is, how does the Reserve Bank control inflation? How does it actually impact upon inflation? And if you remember Unit 3 and the goal of low inflation, it's done through its impact upon activity and the corresponding impact activity has upon demand inflation or prices. So it's really, and that's why we spend a lot of time talking about transmission mechanism on economic activity and the ultimate impact it has upon inflation. So it's quite a complex relationship, but you are expected to understand that relationship between stronger rates of growth, potentially price pressures as you approach full capacity, leading to demand inflationary pressure, which might cause interest rates to be moved up, to slow inflation via slowing demand. And the reverse is what we're seeing at the moment. Very low rates of inflation, as we can see, below the 2 to 3% target. Circle that for us there, Mr. Smithers. There you go. And some concerns about deflation. You can see that little blip there in the last quarter. That's a very interesting phenomenon. I know about you, but the 80s and 90s, Mr. Smithers, inflation,
very high.
7-8%. So that's a really interesting point. That's one of the reasons why, if you get asked why are interest rates so low at the moment, well, because inflation's below the 2 to 3% target. That's a pretty straightforward answer. Yeah,
and I think one of the things that is happening at the moment that the Reserve Bank are trying their best to stimulate aggregate demand, but as we've discussed in both our classes, it's much more effective at slowing inflation than it is picking up aggregate demand and therefore picking up inflation. And we're seeing that problem at the moment. And that's why we're talking about, why everyone's talking about possibly 1.5 interest rate going forward.
So, 3 policy options that the Reserve Bank has. They can run a loose policy setting, obviously what we've got now. They can run a tight policy setting or a tightening of interest rates. Now, this is where it gets a little bit technical, because you could have a tightening of interest rates but still have a loose policy setting. Then there's neutral interest rates, and there's debate about what is a neutral rate of interest, and it does move over time. One of the terms the Reserve Bank has used a lot lately is accommodative, and even on their most recent minutes of their meeting, they've talked about interest rates are at a very accommodative setting. I don't like personally using words such as contractionary or expansionary with monetary policy. I think it just confuses with fiscal policy.
Yep.
Yeah, but they can be used if you wish.
Yeah, so where the neutral point is, the Reserve Bank won't even tell you, and we can only sort of guess that it's around, at the moment, it's probably around 3.5 to 4.
Probably even lower, I reckon.
Yeah, and it's come down
3.
It's come down a lot over the last few years. So factoring that into household decisions is sort of an interesting one.
Because if you said a cash rate of 3, what would that put mortgage rates at? Around 6.5?
6.5, yeah.
Yeah, so that'd be a struggle for some families.
Yep.
6.5, if 7, 7.5, 8, you'd start to see activity falling, I would imagine, but we're surmising.
All right.
So this is, we spent a bit of time on this in class.
Yeah, the transmission channels.
cash flow. You feeling a bit of discretionary income increase lately, Mr. Smith?
Yeah, but it's mostly gone on the renovation. So, that's where my optimism has gone.
But that's not a bad thing because, you could argue that's a different channel working effectively in some ways because construction is a key driver of Victoria's economy, and that's one of the reasons why Victoria's, I think, ranked in the papers this morning as the second fastest economy in Australia.
Yep, nine people working around our tiny Richmond house last week.
Tiny, I think I've got a photo of it. I need a couple more slides. So, in all seriousness, discretionary income, obviously, I've put in a point here, assuming households don't deleverage. And this is what's happened recently. One of the reasons why monetary policy hasn't been as effective as in previous years, perhaps some economists are arguing, is that as interest rates are falling, instead of consumers or households taking that increase in discretionary income and spending and stimulating growth, they're simply keeping the same amount of repayments and reducing their debt levels. Because pre-GFC, a lot of households ran up a lot of debt. Now they're deleveraging or reducing their debt levels. So we haven't seen the multiplier effect or the flow-on effect.
That's right.
Of
they're
the
just
cash flow.
Paying down the principal on their mortgage, as we've discussed it in class. And remember, when you're discussing the cash flow channel, you need to talk about the fact that they've got variable interest rates.
Yeah, very good.
So another comment from the study design was that obviously if you have a fixed rate of interest, which you may do for your own certainty, you won't be getting those reductions in your interest rate if you've fixed it in for 3 years. But most people, or most home loans are variable, the vast majority, and although some people do a bit of both, but it's the variable loan that changes and then the cash flow channel can kick in. Next,
we have cost of credit channel. Sometimes talk about savings and investment channel, if you like. Don't forget, interest rates are simply a reward for postponing current consumption, i.e. a reward for savings or a cost of using someone else's money. So when interest rates go up, generally encourages savings, shouldn't discourage consumption. And then, of course, when interest rates go down, one would hope the reverse occurs. Certainly, I know self-funded retirees are battling to find any decent form of return on their savings at the moment, which is causing a few concerns.
Yeah, and that's one group that are hurting in relation to the low level of interest rates at the moment, particularly the self-funded retirees. I think closely related to this is also the availability of credit channel. Yeah. And remember that usually it means that when interest rates go down, as they are now, that the eligibility criteria is easier to satisfy for the banks to get loans. So it's easier to get a loan when you've got a cash rate at 1.75 rather than 7.25 as it was in 2008, early 2008. All right, now we get to the asset wealth effect.
This is, there we go. I ducked around to Richmond the other day. Apparently this is what your place is going to look like after you reno.
Yes, correct.
Okay. There's a little swimming pool at the back there.
This is proving to be architecturally challenging, but we're getting there.
So, I mean, as you can see, all jokes aside, Melbourne and Sydney house prices have had very, very strong growth rates in the previous years, and this has led to higher asset prices. And those house prices have been driven in part by exceedingly low interest rates. This has meant households have been feeling more wealthy. On paper, they're certainly worth more, so they're more likely to do a couple of things. One, renovate, as in Mr. Smith's case, which adds to construction, adds to growth and activity, or use that money for other purchases, whether it's a new car or holidays or these other things. And the idea is that this wealth effect works both ways, don't forget, and certainly America experienced this when their housing bubble burst. It works the other way as well. But it's not just houses, it can be shares or other equity. The equity market's strong. You'll see people feeling more wealthy and generally start to spend more.
And I think that the share market, as well as the housing market, had a big impact pre-GFC.
Got an apostrophe there, sorry about that.
That's right. So the wealth effect can impact from the share market.
Yes. Now, I forgot to put in the exchange rate effect, which we haven't covered here today, but you do need to know that it's probably one of the more challenging effects, or channels, if you like, and certainly I know we've spent a bit of time on it in class. So students, make sure you revise that. My apologies, I did exclude it from this PowerPoint.
And please, in the few days we've got before the SAC, if you need to have any explanation of these, we've got time in class. All right. Current monetary policy. Now you've got a picture of who's that mad bugger?
That's
Boris.
It's
Boris.
Boris and Brexit. The leader of Brexit. I don't know if you've seen The Downfall of Hitler.
No.
But there's a great YouTube clip at the moment going around students about the downfall of Hitler and a takeoff of Boris and what happened when the Brexit vote came through. So if you get a chance to have a look at that, I'd suggest you do. It's quite funny. In all seriousness, one of the key headwinds, I mean, this gets to this question of why do we have accommodative interest rates? Why do we have such low monetary policy in Australia? Overseas economic conditions, we've got concerns, and clearly interest rates were low before Brexit came through. So it's not just Brexit, it's China. We've got the potential dispute over the China South Seas, which is what I'm referring to down here in this other picture. But China's growth rate has slowed. 6.7% was the latest data coming through. America's growing relatively strongly, but of course there's concerns about the upcoming election in America and whether Mr. Trump becomes president. There's concerns about protectionist policies that he's putting forward. So there are a number of concerns on overseas markets that has an impact upon Australia's business and consumer confidence and demand for Australian resources, which is one of the reasons why we've got relatively low interest rates.
And I think that both consumers and business community are seeing all this uncertainty, which is why we're seeing that monetary policy does have a weakness at the accommodative end, because it's just not turning around that confidence, because they want to wait and see on quite a few things. So exactly the point about Trump and whether protectionism, and that they're a big trading partner of ours. It's not all about China. So all this uncertainty, I think, the Reserve Bank keep pulling the lever, but they're just yet to see the flow through.
And then, of course, we've already talked about inflation, but deflation. It's really bizarre, but a lot of countries these days are more worried about falling prices than rising prices. And Australia historically has not had a problem with deflation, but we have seen.
Earlier graph,
yeah, we have seen it occur here. There are some concerns about the CPI data coming out this week. Will be very low. And whilst you're sitting there thinking, all falling prices is good, deflation is not a good phenomenon to have in an economy. Japan's had it for a long time, very anemic growth in Japan. If we start to see it here, you've got questions about wage prices falling, or wages growth being very low, which leads to low consumption. And don't forget, when prices are falling, it stalls consumers and businesses. They think it erodes business profitability, which erodes their investment, and it also erodes confidence in the economy, and it causes consumers and households to defer spending because they think prices are going to fall, and that can become a deflationary spiral. So it's not something you want in your economy.
No, good point. All right, strengths. Now, why have you got Mr. Nick Xenophon?
Well, one of the key strengths of monetary policy is it is independent of the political cycle, and I think that's a really important strength. That Glenn Stevens at an election, I think the John Howard election and Kevin Rudd election moved interest rates during an election campaign. Most people thought they wouldn't, but he said no. I think the quote was, or words to the effect of, well, no, the Australian people expect me to operate to manage the economy in the best interests for their economic prosperity, irrespective of the political cycle. And he was a very brave man and did it then. And of course, that demonstrated absolutely that the Reserve Bank will be politically independent. Yeah,
that was a big moment. They'd never moved them in an election campaign before that.
Yeah, so
and I think it is its key strength in the fact that they don't have to report back to the people and be voted on every 3 years.
Now, I've put Nick in here instead of Malcolm or Scott Morrison because whilst this is a strength, politically independent, can move quickly, can affect all areas or most areas of the economy pretty quickly, it doesn't require parliamentary approval. One of the key weaknesses of monetary policy is that it is quite blunt in its nature, okay, and it does have a blunt impact upon economic activity.
All right, so we've got the strengths there, and obviously we've gone through the weaknesses in class, and I think one of the key weaknesses we're talking about here is that the Reserve Bank doesn't quite know when the interest rate cuts of last year are going to kick in. They often think it takes 18 months. So there's quite a lag. So perhaps they are at the right setting at the moment. Perhaps they're not. They don't know because the interest rate cuts of last year still possibly haven't quite kicked in.
And when you're comparing strengths and weaknesses, it's clearly you're comparing it against fiscal policy. And one of the key weaknesses of fiscal policy is it is impacted by getting legislation through the Senate, and obviously the current Senate's an issue at the moment. So when you're looking at strengths and weaknesses of monetary policy, strength of monetary policy, independent of the political cycle, as compared to fiscal policy, which requires to get through both houses of parliament. Our current parliamentary situation is quite fragmented, which means they can, the Medicare co-payments, for example, couldn't got through. Budgetary saving measures were stalled in the Senate, and that's a good compare and comparison. Always a good thing to do with strengths and weaknesses about two fiscal policy or two macroeconomic policies.
And speaking of, you've also got to have some knowledge of the policy mix. That is, how the budget or fiscal policy and its compatibility with the monetary policy.
So
now,
what are we calling fiscal policy at the moment?
Slightly contractionary.
Yeah, so a mildly contractionary stance compared with Glenn Stevens and the Reserve Bank, a very loose and accommodative stance. So you can argue quite accurately that they're conflicting. There are some specific stimulatory measures within the budget, but overall its macroeconomic impact upon the economy will be a contractionary one. Not significant, that's admitted, but it is contractionary. So they are working against each other, and there might be good reasons for that when you drill down to the debt and deficit argument, structural imbalances within the budget. These are the things that Scott Morrison's putting forward. But the budget is not adding to growth, and whereas monetary policy is attempting to grow the economy significantly.
All right, so that's the policy mix, which we've had a bit of a discussion about, and we'll finish off, of course, with the Nicholson cartoon. Why don't you just put up a bigger sail, Glenn? Give me a break, will you? So he's got, I think this is in reference to the fact that we've got interest rates at 50-year lows at 1.75%. For people of our age, we're very surprised to see them here at all. I'm sort of semi-delighted, but also it's astounding to think that, they, not that long ago they were 7.25, and not that long before that they were very high. In some of your parents' cases, they'll be able to remember 17% interest rates. So.
Can he get a bigger sale? This question is, you can only go so far with interest rates. Once you get, you can end in that sort of. One of my students was talking about a liquidity trap. You can end up in a situation where you've cut interest rates so low, you've got nowhere to go. You've run out of
ammunition.
Exactly, of fuel, and there is a concern. This is in reference to get a bigger sale. Well, the sale's pretty big in that picture, and the idea is at 1.75. How much further room have we got to go? There are negative interest rates, official negative interest rates around the world, which is a little bit scary. So we've got this situation where we need to question whether monetary policy is actually working. I know we looked at an article from the Reserve Bank in my class where the argument was, yes, it is working, but there are significant headwinds facing the Australian economy, which means that whilst they're pushing, interest rates are pushing growth in one way or pushing this Australian economy in one way, the headwinds in the other way are causing it to stall effectively, and that's one of the concerns.
Definitely. All right, and it's also got the foreign investment. I mean, we still want to attract foreign investment, and if the interest rates go too low, then we can put off foreign investors if our relative interest rates don't have a decent differential.
We are also looking to try and lower the dollar too, with lower interest rates, so to try and get that transition. And it's interesting, Australia's economy is transitioning. There's some good data out there at the moment about New South Wales and Victoria's economy are now picking up the slack from the mining investment boom, and the mining states that would grow the economy pre the sort of end of the mining boom. So there is evidence of tourism increasing, international education, agriculture's picking back up, even manufacturing showing signs of life, and construction is driving the Australian economy. So and consumer confidence is surprisingly resilient at this point in time. So, they are working, but they're probably not working as much as we'd like, I think is the general
or they have historically. All right, wrap that up. I think that's it.
Good luck in the SAC
on Thursday.
Thursday.
In class. We better write it now.
Oh, yeah. Haven't done that.